Imagine you have $10,000 in cash sitting in your bank account. You think you're being smart and safe by keeping your money in cash, right? Wrong. In fact, you're losing money every day without even realizing it. How? Because of inflation, devaluation, theft, and other risks that can destroy your cash and your wealth. That's why you need to watch this video until the end, because I'm going to show you 10 assets that are better and more secure than cash. These assets can help you protect your money from losing value and even grow it over time. Trust me, you don't want to miss this. So grab a pen and paper and get ready to learn how to protect your cash like a pro. So, subscribe to the channel and let's get started. While cash is convenient, it may not be the best solution for long-term financial security. Furthermore, with the rise of digital banking, cash is no longer the only option for financial security. There are a variety of alternatives to cash that can provide higher returns and greater protection against inflation. From investments in stocks, bonds, and mutual funds to savings accounts and CDs, there are numerous options available today for those looking to make their money work for them. Let's look at various alternatives that can both protect your cash and potentially provide higher returns. The first asset we have is safe haven currencies, an asset class that acts as a store of value during times of economic uncertainty. Imagine you are in a stormy sea and you need a lifeboat to keep you safe. That's what safe haven currencies are like. They are the currencies that people trust and use when the markets are in turmoil. Some of the most popular safe haven currencies are the US dollar, the Swiss franc, the Japanese yen, and the euro. These currencies have strong economies, low inflation, and stable politics behind them. When things get rough in the markets, safe haven currencies can help you protect your wealth and avoid losses. They tend to go up in value as people sell their risky assets and buy more of these currencies. This means you can keep more of your money and hedge against market volatility. Additionally, safe haven currencies also have other advantages. They're easy to buy and sell because they are widely used and traded around the world. They also give you a sense of security and stability because they are backed by solid economies and financial systems. Do you want to keep your money safe when the markets are shaky? Safe haven currencies can help you protect your money and avoid losses when things get rough in the markets. They tend to go up in value as people sell their risky assets and buy more of these currencies. This means you can keep more of your money and hedge against market volatility. But how do you invest in safe haven currencies? There are different ways to do that. You can use foreign exchange platforms or currency ETFs to buy and sell these currencies. Two examples of respected and trusted foreign exchange platforms or currency ETFs to buy and sell these currencies are Oanda. This is a foreign exchange platform that offers low spreads, fast execution, and access to over 70 currency pairs. It also provides advanced trading tools, market analysis, and educational resources. Oanda is regulated by multiple authorities, such as the U.S. Commodity Futures Trading Commission, CFTC, and the UK Financial Conduct Authority, FCA. On the other hand, we have Invesco DB US Dollar Index, Bullish Fund, UUP. This is a currency ETF that tracks the performance of the US dollar against a basket of 6 major currencies: the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and the Swiss franc. It aims to replicate the movements of the US dollar index, DXY, which measures the value of the US dollar relative to other currencies. UUP has low fees, high liquidity, and exposure to the most widely traded currency in the world. Another way to invest in safe haven currencies is to follow what some notable investors and institutions do, such as Ray Dalio, the founder of Bridgewater Associates, one of the world's largest hedge funds. Ray Dalio has stated that he likes to diversify his portfolio with safe haven currencies, such as the Swiss franc and Japanese yen. He believes that these currencies can help him balance his risk and return in various scenarios. Did you know that the Swiss franc significantly strengthened during the 2008 financial crisis? Many investors saw it as a safe haven, and those who had invested in it correctly gained handsomely. It's a perfect example of how safe haven currencies may act as a buffer during stressful times. Let me ask you a question. Can you think of any other assets that are not directly related to cash but still hold significant value? Consider it for a moment and let me know in the comments area below. Investing in safe haven currencies carries risks like any other investment, such as global economic conditions, geopolitical events, and interest rate differences impacting the currency's strength. Therefore, you have to do your research and analysis before you invest. Now that we've covered safe haven currencies, let's move on to the next of the 10 assets that can be more secure than cash: goods money. An example of an asset that is not directly related to cash, but still holds significant value is goods money. Have you ever thought of investing in something other than cash or stocks? Something that has real value and can be used to buy and sell things? If so, you might be interested in learning about goods money. Goods money is a type of asset that consists of physical goods that people want and need. For example, metals like silver, copper, and platinum are goods money because they are used in many products and have a limited supply. Other examples are oil, natural gas, and agricultural products, which are essential for energy and food. One of the advantages of goods money is that it protects you from inflation and currency fluctuations. When the value of paper money goes down, the value of goods money goes up. This means you can preserve your wealth and purchasing power. Another advantage is that goods money is influenced by global events and trends, such as industrial demand, political conflicts, and environmental issues. Do you want to invest in goods money? If so, you need to do your homework and keep an eye on the factors that affect commodity prices. Let's take a look at some of the main types of goods money and what drives their value. First, we have precious metals like silver, gold, and platinum. These metals are shiny, scarce, and useful for many things. They have been used as money and as a way to store wealth for a long time. Their value depends on things like how the economy is doing, what's happening in the world, and how investors feel about them. Next, we have industrial commodities like oil, natural gas, and coal. These commodities are important for running industries and growing the economy. Their value depends on things like how much people want them, how much is produced, what's going on in the countries that produce them, and what kind of new energy sources are available. Finally, we have agricultural products like wheat, corn, soybeans, and coffee. These commodities are essential for feeding people and animals. Their value depends on things like how the weather is, how much is produced and consumed, what the government does, and what people like to eat and drink. Investing in goods money can be done in different ways. Some investors use ETFs that follow commodity prices, while others buy physical commodities or futures contracts that let them buy or sell them at a certain price and date. However, investing in goods money is not without risks. Commodity prices can change quickly and unpredictably due to various factors. That's why it's important to spread your investments, stay updated on market trends, and get professional advice when needed. Goods money can offer you a chance to diversify your portfolio and take advantage of the natural value of physical goods. One example of a famous investor who had invested in goods money is John Templeton. Templeton was one of the past century's top contrarians who bought low during the Great Depression and sold high during the internet boom. He created some of the world's largest and most successful international investment funds, which included commodities such as precious metals and oil. He was knighted by Queen Elizabeth II for his many accomplishments. Templeton believed that investing in goods money offered portfolio diversification and protection against inflation and currency devaluation. However, goods money is an alternative asset class that can offer you diversification, protection, and growth opportunities. If you are looking for a way to spice up your portfolio and hedge against uncertainty, you might want to give goods money a try. Let us now shift our focus to the next asset that is better than cash and explore how these can protect your money: industrial commodities. Are you looking to invest in something essential to many industries that can help you benefit from global growth? If so, you may want to consider industrial commodities. These are goods used to manufacture cars, electronics, buildings, and energy, among other things. Some examples of industrial commodities are copper, aluminum, zinc, iron ore, and crude oil. These goods are in high demand in many parts of the world, especially in developing countries that need them for their economic development. Investing in industrial commodities can give you several benefits. First of all, you can get exposure to the global economy and how well it is doing. When industries grow and need more commodities, the prices of these goods can go up, giving you a chance to make money. Second of all, you can diversify your portfolio and lower your risk. Industrial commodities often behave differently from other assets like stocks and bonds. This means they can balance out your portfolio and protect you from market volatility. On the other hand, many smart investors and organizations know the value of industrial commodities and invest in them regularly. For example, big investment firms and hedge funds often put some of their money in commodities to profit from price changes and global economic growth. There are different ways to invest in industrial commodities. You can buy commodity futures contracts, which are agreements to buy or sell a certain amount of a commodity at a specific price and date. You can also invest in ETFs that track the performance of a basket of commodities. For example, you can invest in an ETF that tracks the performance of a commodity index, such as the S&P GSCI or the Bloomberg Commodity Index. These indices measure the price movements of a group of commodities, such as energy, metals, and agriculture. Or you can buy stocks of companies that produce or distribute industrial commodities. But you should also know that investing in industrial commodities has risks. The prices of these goods can change quickly and unpredictably due to various factors. These include how much people want and produce them, what's happening in the world, what kind of new technologies are available, and what the government does. That's why you need to be well informed about market trends, watch supply and demand carefully, and look at the big picture of the economy when you invest in industrial commodities. Investing in industrial commodities can give you a chance to profit from the growth of important market goods. But you need to be careful and smart about your investment choices and manage your risks well. Jim Rogers, a well-known investor, is known for his trust in the long-term potential of industrial commodities. Throughout his career, he has made profitable investments in commodities and feels that they are an important component of a well-diversified portfolio. Rogers' experiences serve as a source of inspiration for investors looking to gain exposure to the volatile world of industrial commodities. By the way, if you're enjoying this video so far and want more content like this, comment the word "more" so I know. The next of 10 assets that can outshine cash in terms of security and returns: real estate investment trusts, REITs. Are you interested in investing in real estate without having to buy and manage properties yourself? If so, you may want to consider investing in real estate investment trusts, REITs. REITs are companies that own and operate various types of real estate and generate income. These can include apartments, offices, malls, hotels, and even cell towers and data centers. One of the main advantages of investing in REITs is that they can give you regular income from dividends. Dividends are payments that companies make to their shareholders from their profits. Dividends are usually paid quarterly or annually, and they can vary depending on the company's performance and policies. Here is an example to explain how a company pays dividends to its shareholders from its profits. Alice is an investor who owns 100 shares of XYZ Inc., a company that owns and operates several shopping malls across the country. XYZ Inc. is a REII that pays quarterly dividends to its shareholders from its rental income and other sources of revenue. One day, Alice receives a letter from XYZ Inc. informing her that the company has declared a dividend of 50 cents per share for the last quarter. This means that Alice will receive a dividend payment of 100 times 50 cents equal to $50 from the company. Alice is happy to receive this dividend as it represents a part of the company's profits that is distributed to her as a shareholder. She can use this dividend to pay for her expenses, save for her future, or reinvest in more shares of XYZ Inc. Alice decides to reinvest her dividend in more shares of XYZ Inc., as she believes that the company has a strong business model and growth potential. She uses an online brokerage platform that allows her to automatically reinvest her dividends without paying any fees or commissions. By reinvesting her dividends, Alice increases her ownership stake in XYZ Inc. and benefits from the power of compounding. She hopes that the company will continue to pay and increase its dividends over time, as well as appreciate in value. Alice enjoys being a shareholder of XYZ Inc. as she receives regular income from dividends and participates in the success of the company. Overall, dividends can be a source of passive income for investors who hold REITs, helping them to reinvest their earnings and compound their returns over time. Additionally, dividends can also signal the financial health and stability of a company, as well as its commitment to rewarding its shareholders. However, dividends are not guaranteed and can be cut or suspended by the company if its profits decline or if it faces financial difficulties. The taxation of these dividends can also vary depending on the type of REIT and the investor's tax situation. Therefore, it is important to understand a REIT's dividend policy and history before investing in it. Additionally, REITs can help diversify your portfolio, as they usually invest in many properties across different sectors and locations. This can help you reduce your risk from a single property or market. You can invest in REITs through two ways: public REITs that trade on stock exchanges, or private REITs that are only for qualified investors. You should always check the performance, management team, and real estate assets of a REIT before investing in it. Some famous investors like Sam Zell and David Simon have made a lot of money by investing in real estate and REITs. They have shown how to get high returns by buying, running, and selling properties at the right time and place. Moving on to the next asset that is better than cash, this asset has grabbed the imagination of people for centuries: gold and other precious metals. Have you ever wondered why some investors are obsessed with precious metals? These shiny substances have a long history of attracting people with their value, rarity, and ability to protect wealth in times of trouble. Gold is the most famous of these metals, and for good reason. It has been used as money for thousands of years and has shaped the course of civilizations. But gold is not the only precious metal out there. Silver, platinum, and palladium are also valuable and sought after by investors. Precious metals are like a shield against the storms of the economy. When inflation, currency crises, or political turmoil threaten to erode the value of other assets, precious metals tend to hold their ground or even rise in price. This is because they have a limited supply and a strong demand around the world. If you want to join the ranks of precious metal investors, you have several options. You can buy physical metal in the form of bars or coins and store it somewhere safe. You can also invest in funds that track the prices of these metals or buy stocks of companies that mine or produce them. But before you dive into the world of precious metals, be aware of the risks involved. The prices of these metals can fluctuate depending on various factors such as global events, interest rates, and market sentiment. Also, if you own physical metal, you have to pay for storage and insurance costs. Precious metals are not a guarantee of profit, but they can be a valuable addition to your portfolio. If you are thinking about investing in gold and other precious metals, you need to do your homework. To put it simply, you need to watch the market trends and figure out how these assets fit into your overall portfolio. Gold and other precious metals are not just shiny objects. They are powerful tools to protect your wealth from economic uncertainties. They have a long history of being valuable and scarce, and they don't lose their purchasing power like paper money does. But investing in precious metals is not a sure thing. You have to be aware of the market conditions and the risks involved. One of the most outspoken advocates of gold investing is Peter Schiff, a stockbroker and financial commentator. He believes that gold is on the launch pad and will soar to new heights in the current and upcoming years. He thinks that inflation is going to get worse, not better, and that the Fed will not be able to raise interest rates enough to fight it. He also thinks that the U.S. economy is weak and will face a recession or worse. He advises investors to buy physical gold or funds that track the prices of precious metals or even mining stocks. Schiff is not alone in his bullish view on gold. Nigel Farage, a former politician and broadcaster, also believes that gold will be the best investment to make. He agrees with Schiff that inflation is a major threat and that the Fed will not be able to control it. He also sees geopolitical risks and currency crises as factors that will drive up the demand for gold. Of course, not everyone agrees with Schiff and Farage. Some analysts think that gold prices will fall or stagnate this year and the next, depending on various factors such as global events, interest rates, and market sentiment. They also point out that owning physical gold involves storage and insurance costs, and that mining stocks are subject to operational risks. The bottom line is that investing in gold and other precious metals requires careful research and analysis, as well as a clear understanding of your goals and risk tolerance. Precious metals can offer you a way to preserve value and hedge against economic uncertainties, but they are not a guarantee of profit. You have to weigh the pros and cons of each option and make an informed decision based on your own situation. Let us now switch to the next asset, which is better and secure than cash. This asset type has the potential for both income and growth. Dividend stock funds. Imagine you are a part owner of several successful companies. Every quarter, these companies send you a check for your share of their profits. That's what dividend stock funds can do for you. They are funds that buy stocks of companies that pay dividends. Dividends are cash payments that companies make to their shareholders from their earnings. Furthermore, dividend stock funds can give you a regular income from your investments. They also let you invest in a variety of quality companies that have steady earnings and a history of paying dividends. These companies are usually well-established and have stable businesses. They are often in industries like utilities, consumer staples, financial services, and healthcare. You can invest in dividend stock funds through mutual funds or ETFs that focus on dividend-paying stocks. But you have to watch out for the risks involved. The prices of dividend-paying stocks can move up or down depending on the economy, the industry, and the company's dividend policy. You also have to consider the fees and taxes that can reduce your returns. For example, let's say you invested $10,000 in a dividend stock fund that holds 100 stocks of different companies. The fund has an annual dividend yield of 4%, which means it pays $400 in dividends per year for every $10,000 invested. The fund also has an annual expense ratio of 0.5%, which means it charges $50 per year for every $10,000 invested. Assuming the fund's price remains the same, your net return after 1 year would be $350, calculated as $400 minus $50. However, if the fund's price increases by 10%, your net return would be $1,350, calculated as $400 plus $1,000 minus $50. On the other hand, if the fund's price goes down by 10%, your net return would be a loss of $650. The final calculation is $400 minus $1,000 minus $50. Additionally, you may have to pay taxes on your dividends and capital gains, depending on your tax situation. Let us now get into the world of government bonds. The next asset better than cash. This is an asset class that provides stability and income to investors. Government bonds are debt securities issued by national governments in order to raise capital. These bonds are considered as one of the safest investments because they are backed by the issuing government's complete faith and credit. Government bonds are less volatile than stocks, making them a great way to bring stability to your portfolio. Additionally, fixed interest payments can provide a consistent income stream. When investing in bonds, however, it is important to consider inflation and interest rate concerns. Legendary investor Bill Gross, known as the Bond King, made his fortune through successful bond investing. His talent in studying and trading government bonds has made him one of the most successful investors in the fixed income market. Let us now explore the next of 10 assets that may be better and more secure than cash. Cryptocurrencies. This asset class has received immense popularity and media attention in recent years. Cryptocurrencies, such as Bitcoin and Ethereum, are digital assets that use cryptography to safeguard transactions and manage the generation of additional units. They provide decentralization, transparency, and the potential for high rewards. While cryptocurrencies have seen substantial volatility, they have also provided spectacular gains for early users. Investing in cryptocurrencies takes careful consideration because it is a rapidly developing and complex sector. Elon Musk is one of the most well-known investors who has embraced cryptocurrencies. He invested $1.5 billion in Bitcoin through his firm, Tesla, and advocated for its adoption. This move not only increased the value of the cryptocurrency, but also cemented its presence in the financial scene. Now, let's explore an asset that's better than cash. This asset class goes beyond mere protection and aims to thrive in the face of adversity: anti-fragile assets. Do you want to invest in assets that not only survive but thrive in chaos? Then you might want to consider anti-fragile assets. These are assets that love volatility and uncertainty. They don't just resist market shocks, they actually get better and stronger when things get tough. These are the kinds of assets that have unique competitive advantages, intellectual property rights, or new technology. By investing in anti-fragile assets, you can profit from market disturbances and maybe even beat the market in hard times. For example, Mark Cuban, the billionaire entrepreneur and investor, is a fan of anti-fragility investing. He believes that anti-fragile assets are the ones that can disrupt and innovate in any environment. He advises investors to look for assets that have high growth potential, low debt, and strong customer loyalty. The next asset better than cash is an asset class that provides broad market exposure and long-term growth potential: index funds. Do you want to invest in the whole market without paying a lot of fees? Then you might want to consider index funds. These are funds that copy the performance of a specific market index, such as the S&P 500. These funds give you access to a large number of stocks or bonds that belong to the index. Index funds are popular for their low costs and wide market coverage, making them a great option for long-term investors. Investing in index funds lets you enjoy the overall market growth and also benefit from compounding returns. Compounding returns means that your money grows faster over time because you earn interest on your interest. One of the most famous supporters of index fund investing is Jack Bogle, the founder of Vanguard Group. He was one of the pioneers of index fund investing and created the first index mutual fund in 1976. Bogle believed that most investors would be better off investing in low-cost index funds rather than trying to beat the market through active stock picking. He argued that active stock picking involves higher fees, higher taxes, and higher risks, which can reduce your returns over time. His advice for investors is to buy and hold index funds for the long term and ignore short-term market fluctuations. Now that we've gone through these 10 fantastic assets, it's time to put what we've learned into practice. Let's talk about how you might invest in these assets and potentially get a high return on your money. When investing in these assets, it is crucial to examine your financial goals, risk tolerance, and time horizon. Diversification is essential because it spreads the risks and possible benefits across multiple asset types. Before making any investing decisions, it is best to talk with a financial professional or conduct extensive research. They can give you unique advice depending on your specific situation. Remember, investing is a long-term game. When it comes to accumulating wealth, patience and discipline are essential. So keep focused on your investment strategy and avoid making rash decisions based on short-term market swings. Let's take a quick moment to illustrate the potential earnings from these investments. Suppose you invested $10,000 equally across the 10 assets we discussed earlier. Over a 5-year period, if each asset class yielded an average annual return of 8%, your initial investment would grow to approximately $14,693. If you invest more, your returns will be higher. That's the basic idea. Keep in mind that returns can vary. And this is just a hypothetical example. Did you know that many successful investors diversify their portfolios across asset classes? They understand the need of diversifying their investments in order to capitalize on future growth possibilities while properly managing risks. This video is filled with useful information about 10 assets that are better and safer than cash. Safe haven currencies, products money, industrial commodities, REITs, gold and precious metals, dividend stock funds, government bonds, cryptocurrencies, anti-fragile assets, and index funds have all been discussed. Remember that investing is a journey in which you must keep informed and adapt to changing market conditions. Before making any investing decisions, always conduct extensive research and consider seeking expert advice. For those who have asked, which brokerage do I use? This video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. Now, if you want to know about other assets that will make you earn money, I recommend you watch this video next. Thank you for joining us today. We hope you found this video informative and exciting. If you enjoyed it, give it a thumbs up, share it with your friends, and don't forget to subscribe to our channel for more wealth-building content. Until next time, happy investing, and may your financial journey be prosperous.